Today, we're going to dive into one of the most critical parts of successful investing, and it's not what you might think. It's all about the mind. You see, it isn't just about finding a great company, it's about having the psychological strength to actually hold a large position as it grows. We're going to explore the mental fortitude that's really required to achieve those extraordinary life-changing returns. Peter Lynch just nails it with this quote. The analysis, what he calls the brainpower, well, that's something most of us can learn. But the emotional resilience, the stomach, that's what truly separates the good investors from the great ones. And that's exactly what we're going to unpack here. So, what is the actual strategy that historically generates the vast majority of an investor's outperformance? It's this simple idea, writing a multi-year winner in size. This isn't about finding hundreds of little wins. No, it's about identifying a few truly exceptional opportunities and then committing to them for the long haul. Let's take a look at the patterns of those who have really mastered this. You know, when you study legendary investors like Warren Buffett and Charlie Munger, you start to see a clear pattern emerge. First, their best ideas are never small bets. They are significant positions, often 15, 20, even 40% of the portfolio. Second, they buy more as the stock goes up. They press their winners. And third, they are incredibly patient, holding on for years to let the full story play out. Charlie Munger's point here is such a direct challenge to the conventional wisdom of broad diversification. He's arguing that true outperformance doesn't come from owning a little bit of everything. It comes from knowing just a few businesses so incredibly well that you can invest with unshakable conviction. And Buffett reinforces this same idea with his famous 20-hole punch card theory. Just imagine for a second that you only get to make 20 investment decisions in your entire life. This mental model forces an incredible level of discipline. It makes you wait for the truly great opportunities, and when you finally find one, to invest with the high conviction it deserves. Okay, so we know what these investors do. They concentrate their capital into their best ideas. The real question, though, is how do they do it with so much confidence? Well, the answer is a deep, fundamental conviction that allows them to completely tune out the market's daily noise and focus only on a company's true long-term value. So what do we mean by fundamental conviction? It's a belief in a company's future that's built on your own rigorous analysis, not on charts, not on market chatter, but on your own work. This deep understanding of a company's long-term earnings potential is what gives you the strength to hold on, or even buy more, when everyone else is getting nervous. Now, here's a question that really gets to the heart of this entire mindset. It sounds completely counterintuitive, I know, but it's a concept that great investors understand deeply. How is it actually possible for a stock's price to double, yet its valuation becomes even more attractive? Let's just walk through how this works. Let's look at a simple example. Say a stock is at $100 with $10 of earnings power. That means it's trading at a 10x multiple. Then the business just improves dramatically, and its earnings power quadruples to $40. The stock price doubles to $200. But now look at the valuation. At a $200 price and $40 of earnings, the new multiple is just 5x. And this really illustrates the point perfectly. Even though the stock price went up 100%, the explosive growth in the underlying business means that from a valuation standpoint, it's now twice as cheap as it was before. This is exactly the kind of insight that fundamental conviction gives you, allowing you to buy more even after a huge run-up in price. This also shows us why position size is, well, everything. Percentage gains can be really misleading. As this chart shows, a 20% gain on a large position can be worth so much more to your portfolio than a 50% gain on a small one. At the end of the day, it's the dollar gains that matter, and that comes directly from how much you're willing to invest. Now, all of this brings us to the most difficult part of the entire process, the internal battle. Holding a large, concentrated position for years is an intense psychological challenge. It really is like navigating a mental gauntlet of biases, fears, and emotions that are constantly telling you to do the exact wrong thing. There are a few mental hurdles that consistently trip investors up. A chart that goes nearly vertical triggers a powerful, almost primal instinct to sell and lock in the gains. Near-term valuation multiples can often look expensive because the consensus estimates just haven't caught up to the new reality. Then there's a fear of social proof, of looking reckless to your peers. And finally, there's just the simple, emotional weight of managing a position whose daily price swings are a huge amount of money. And here is the frustrating paradox in all of this. It doesn't matter if the position is up for the day or down for the day. your brain can trick you into the same fear-based reaction. On a down day, you think, I better trim this before I lose my gains. On an up day, you think, I better take some profits before these gains disappear. Both thoughts lead to the same non-fundamental impulse, to sell, often way too early. So the crucial takeaway here is this. When your impulse to act is being driven by fear and not by a change in the fundamentals, the right decision is almost always to simply do nothing. This urge to always be tinkering is called activity bias, and it's one of the most destructive forces in investing. True discipline is just letting your thesis play out. So if this psychological strength is so important, how do you actually develop it? Well, it's not something you can learn from a book. An investor's stomach, as Peter Lynch called it, is forged over time, through direct and often pretty difficult experience. Let's look at how that actually happens. This kind of temperament is built in the real world. It starts by putting actual capital at risk, not paper trading. It requires managing a large position from the very beginning to the very end, feeling all the emotional highs and lows along the way. It means experiencing that gut-wrenching feeling of a major drawdown and learning how to think clearly through it. And ultimately, this whole process forces you to learn your own psychological triggers and weaknesses. And that really brings us to the ultimate point here. You can have the best investment idea in the entire world, but it is effectively worthless if you lack the self-mastery to actually execute on it. Your ability to see a great idea through to its conclusion is entirely a function of your own patience, your discipline, and your emotional temperament. So as we wrap this up, I'll just leave you with this question to think about. The next time you believe you've found a truly exceptional investment, remember that the real test won't just be whether your analysis is correct. The real test will be whether you've cultivated the stomach to see it all the way through.